Welcome back, everyone. I'm Javi, and today we are doing a market update on Senseonic Holdings. They've had some recent announcements from their CEO, their CFO, and they also have updates on the launch of their 365 continuous glucose monitor. So if you're interested, just stick around and let's dive right in. Okay, so jumping right in, we have Senseonics at 45 cents with a total value of 32,000 in this portfolio. And I do own 71,945 shares with an average cost of 45. So if you haven't watched my previous video, I did own more shares and my average price was higher at 49 cents a share. So I'll link it up above if you want to know more about the summary of Senseonics because we go more in detail about that stock at that time. So make sure you go watch it. But I did end up averaging down, but I also took a loss in the beginning because I sold some shares at a 26% decrease. But I did diversify into Hyperfine Inc., which I also think is an undervalued stock. So I do hope that both will continue growing in the long term. I know they are high risk and potentially we could get that high reward in the end. So scrolling down, I do want to cover some of these articles that they published. So I'll cover the Eversense 365 launch, which I opened up over here. Senseonic Holdings provides an update on Eversense 365 launch, and they leave a little snippet of the company. It's a medical technology company focused on the development and manufacturing of long-term implantable continuous glucose monitoring devices for people with diabetes. Today provided commercial updates related to the Eversense 365 launch. Eversense 365 commercial launch update. They launched Eversense 365 in October with global commercial partner Ascensia Diabetes Care and began shipping products in November. They're seeing strong interest in Eversense 365 as evidenced by the following early launch performance indicators. Excuse me. Direct-to-consumer leads in each of October and November were more than double the number of leads in pre-launch months. New patient shipments in November were the highest compared to any month since inception of Essentia partnership, excuse me. Since launch, Eversense 365 has already shown a 42% increase in the number of providers prescribing Eversense and a 69% increase in prescriptions from top prescribers compared to the pre-launch rate in 24. One third of Eversense 365 prescribers are new first-time Eversense prescribers. The number of patients switching to Eversense monthly from competitive CGMs has increased 47% since Eversense 365 launch. Remains on target to achieve annual growth of approximately 50% in patient installed base at the end of 24 as compared with 23. Reiterated full year 2024 global net revenue guidance of approximately 22 million. Ryan Hansen, president of Ascensia's CGM division, commented, "We are thrilled to have a world-class product that so fully addresses patient needs for a long-term CGM with minimal data disruptions and complete flexibility. Patients have been elated with Eversense 365's reduction in calibration and ease of use, and providers are getting the consistent flow of data required to manage their patient's disease. We believe this is driving the double-digit growth in the monthly patients since 365 launch, switching from competitive CGM, and a triple-digit increase in type 2 basal-only patients, the largest market segment opportunity. Eversense 365 is really a win-win for everyone, and 4 strong early launch performance indicators are showing meaningful improvements in the key metrics we track. 24 has been a landmark year for Senseonics, achieving our long-term goal of commercializing the Eversense 365 product, providing people with diabetes and a convenient and accurate solution to monitoring blood glucose for an entire year with a single sensor," said Tim Goodnow, who has a PhD and is the president and chief executive officer of Senseonics. "We are excited to see a strong early performance indicators that we believe reflect the commercial potential of this groundbreaking product. Patient and providers lead a new interest from health systems and have all increased significantly following 365 launch. And we expect that a heightened level of interest will drive our results for 25. We intend to provide updates on the ongoing 365 launch as well as on our product portfolio portfolio development, pump connectivity, additional healthcare systems, and our ex-US commercial launch of Eversense 365 over the course of 25. So here's the bad news. Additionally, in an effort to enhance Senseonics' appeal to institutional and other investors, we are seeking to execute a reverse stock split pending shareholder approval in January 25, continued Dr. Goodnow. We understand that many institutional investors and other funds have internal policies and practices that limit their ability to invest in low price stocks, and we are seeking a reverse stock split to overcome these limitations, which we believe will address this impediment and make it easier for these investors to invest in Senseonics stock. So that's the bad news, because at the end of the day, some investors see stock splits as a negative because they will increase the price of the stock, but whatever they increase it by, they'll divide the number of shares that you have. Intrinsically, nothing really changes about the company, the valuation, except the price and the number of shares that you have. There will be fewer shares on the market, which if Senseonics continues to perform well, their earnings per share and all of those other numbers will actually improve as well. But as of right now, I think reverse stock splits are always a negative sentiment in the market. So there is potential that Senseonics can continue dropping, because if it gets approved in January, the stock is going to go gone. So definitely be wary of that. And I know for sure some people will be mad that their shares will be cut in half or cut in threes. Depends on what the stock split ratio would be. So if you don't know about stock splits, let me know in the comments. I might make a video about that as well. But they are usually seen a as a negative thing for the stock. Okay, so moving on to some good news. There were some insider purchases for Senseonics the last few days, starting with Frederick T. Sullivan, the chief financial officer of Senseonics. He bought 124,933 shares of the company yesterday, and that takes his entire holding to 5.3%. The other insider buyer was the CEO, who purchased 315,000 shares of the company. That takes his entire holding to 3%. So the last time I saw this happening was with SoFi Investments or SoFi Bank, when CEO Anthony Noto actually bought shares of SoFi. And next thing, like a few months later, the stock ended up shooting up 100%. So I have high hopes for the stock, and the fact that the CEO and the CFO are buying these shares shows confidence in what they're actually doing with the company, and that instills trust in me that I know for sure they're invested financially as well to try to make this company better. So for that reason, I do think this will be great news. Some hedge fund activity as well. There were 36 institutional investors that added shares of Senseonics, but there were 61 of them that actually decreased their position in the recent quarter. And they have that list right here. So AXA removed 1.1 million, 100% of their portfolio. Then let's see, removed, added. So somebody, Symmetry Partners LLC, added 467,000 shares. Removed, added. Vanguard Group Inc. added 342,381 shares to their portfolio in quarter 324. So that is good information to know. But the really good ones to look at is Frederick Sullivan and Tim Goodnow, because that means they have confidence in this stock to perform well. So why would you buy something if you know it's going to do bad, especially if you are working in that company? So I have confidence in these two. I think they made the right move. I think that could potentially send the stock soaring. Maybe we don't have to do a stock split, but even if they do have a stock split, I want you to know there's nothing intrinsic that changes about the stock except the share price. Okay, so I do want to cover what a reverse stock split is and how it impacts the stock price and the shares that you have. Otherwise, intrinsically, nothing really changes about the stock. So we'll cover some examples real quick. So let's say you have 10,000 shares with the current price at 45 cents. Your total value would be $4,500 right now. With a reverse split, they can do a ratio of 1 for 2. So for every 2 shares that you have, you'll get one. For every 3 shares that you have, you'll get one for the 1 for 3. And a 1 for 10, for every 10 shares, you'll get 1 share. So starting with the first example, you will have 10,000 shares, divide that by 2. So you will have 5,000 shares left. But the thing is, you would multiply the price as well by 2. So it'll be zero point 0.9 as the new price, and your total value remains the same. Ratio of 1 for 3, you'll have 3,333 shares left, and the price would increase to 1.35. I don't see the 1 for 2 happening because the goal usually for a reverse stock split is to maintain the price above $1 so they can be compliant with the NASDAQ listing and the New York Stock Exchange. So I do not see them doing the 1 for 2 at this moment unless the price does go up to like 80 cents or 70 cents. So I do see them potentially considering the 1 for 2. But the 1 for 3 is, I believe, more realistic that they might actually end up doing. But the highest I've ever seen a stock perform for a reverse stock split was 20. So a 1 for 20. So for every 20 shares that you have, you just got one. But again, nothing really changes. So our highest ratio here that I'm calculating for is 1 for 10. So you will have 1,000 shares left, but the price would change to 4.5 would be the new price. But the thing is, the value would still remain the same at 4,500. Another example would be the forward split, which is the opposite of a reverse split. And that's the type of split that Nvidia has done, Tesla has done it, and 10 for 1. So you get 10 shares for every 1 share that you have. And usually a forward split is considered positive because you will end up with more shares. And in the long term, you could potentially benefit from price appreciation if you never sell any of your shares with the forward split. But the thing is, a lot of people would sell, so it never really matters anyways. As an example, Berkshire Hathaway has never done any forward splits or stock splits, or they never paid any dividends as well. So that stock is currently at like 237,000 or something like that per share. So in order to buy 1 share, you need 230,000. So that's very high. They could benefit from a forward split where they'll divide that price by whatever ratio they choose to do. And I know Tesla and Nvidia have done forward splits. A lot of companies do reverse splits as well, especially the ones that are not compliant with NASDAQ or New York Stock Exchange listing requirements. So that's one of the reasons for the companies do one as well. It's just to keep that price above $1. But otherwise, it's just all for optics. Nothing really changes. The value remains the same, and you basically get more shares or you have less shares with a higher price. So it's all for optics. Overall, right now, I am a holder of this stock. I'm not really buying any more shares at this point. But for any newcomers to the stock, I would recommend a buy because I do think that it's reached its all-time low the last few weeks, and I do think that it has the potential to do what it did back in 2020. That was actually the first time I actually bought it was back in 2020. I bought it at 40 something cents and it blew up to $5 and I sold covered calls on it. So I made more money on top of that. And ever since I've since sold out. So I've been kind of been watching it this whole time and going back to it now, I'm realizing it's back in the 40 cents territory. And since this time period from 2020 till now, they've made so much progress. Back then, they were at the 60-day, at the 90-day product to the 180-day product. And now they have the 365-day product that could potentially be the catalyst. Just that alone will be a catalyst for it. But there have been analysts that raised their price target on it as well to $6, and there are some that also dropped it from 6 to like $3. So nonetheless, from 40 cents to $6 or $3 is a huge movement for this stock. So for that reason, I'm just holding because I've already invested a huge chunk of it into the stock. Again, though, I do have 92 different stocks in my portfolio. I have stocks. I have private equity as well in Star Engine. I have real estate. I have cryptocurrencies. So definitely staying diversified and not going all in on one type of stock is a good way to pretty much mitigate the risk of losing all your funds. So definitely, if you liked this video, let me see if I missed anything. I write down my notes here. But yeah, so if you have any questions or concerns, please let me know in the comment section. I hope you like this video. Make sure you do smash that like button because it does help this channel a lot. And I do hope to see you in the next video. See ya.